You finally did it. You retired. But while you are planning your vacation or looking forward to spending more time with your family, the IRS is planning something else entirely. The second you stop receiving a standard W-2 paycheck, the tax rules you have followed for the last 40 years are entirely thrown out the window. In fact, there are 10 specific things the IRS expects you to do the moment you retire, and if you miss just one of them, especially a silent trap hidden in the new 2026 tax codes, you could forfeit up to 25% of your life savings and penalties overnight. You have spent your whole life paying taxes through an employer. They did all the complex math, they withheld the money from your paycheck, and you just filed a simple return every April. But the moment you retire, you become your own payroll department. I am here to protect you from the financial landmines that silently destroy otherwise perfect retirement plans. Today, we are going to walk through the 10 exact steps the IRS demands you take as a new retiree. We are going to cover everything from a silent Medicare surcharge that drains your Social Security to the new 2026 Secure 2.0 catch-up mandates, all the way to a completely counterintuitive strategy regarding your 401k rollovers. Stick with me to the very end because the absolute last point we will cover involves a mistake with required minimum distributions that the IRS actively monitors and penalizes at a staggering 25%. Let's secure your retirement. Number 1. Mastering Form W-4P and W-4R. When you were working, your employer handed you a Form W-4 to determine how much of your paycheck should go to the IRS. But in retirement, the IRS expects you to initiate this process yourself using two entirely different documents: Form W-4P for periodic pension payments and Form W-4R for non-periodic distributions from your IRAs or 401ks. This is where the trap snaps shut on most new retirees. Let us say you decide to pull a lump sum of $40,000 from your traditional IRA to pay off your mortgage the month you retire. If you simply log into your brokerage account and click Transfer, the financial institution is going to apply a default federal tax withholding of exactly 10%. But what if your combined household income for that year puts you in the 22% or 24% tax bracket? You have just massively underwithheld your taxes. The IRS does not wait patiently until April 15th for you to make up that difference. The United States operates on a pay-as-you-go tax system. If you reach the end of the year and you have dramatically underpaid what you owe, the IRS will hit you with an estimated tax penalty. The solution is simple but completely overlooked. You must proactively file Form W-4R with your custodian before you take that distribution, explicitly instructing them to withhold the correct percentage that aligns with your true marginal tax bracket. Taking control of your withholdings is the very first thing the IRS expects you to manage. Number 2, surviving the first-year tax trap. There is a psychological phenomenon that happens the moment you leave the workforce. You feel liberated and suddenly you want to celebrate. Perhaps you want to buy an RV, remodel the kitchen, or take that dream vacation to Europe. To fund this, you decide to withdraw a large chunk of money from your tax-deferred 401k. Here is a sobering financial reality. The year you retire is mathematically one of the most dangerous years to take large discretionary withdrawals from your retirement accounts. Imagine you decide to retire on June 30th. For the first 6 months of the year, you were earning your peak salary. When you left the company, they likely paid you out for accrued vacation time, sick leave, and perhaps even handed you a generous severance package. Your earned income for that year is already exceptionally high. If you then pull an additional $50,000 from your 401k in October to buy that R&V, the IRS stacks that $50,000 directly on top of your peak working income. Every single dollar of that withdrawal is going to be taxed at your highest possible marginal tax bracket. The IRS expects you to understand that your 401k withdrawals are ordinary income. The protective strategy here is patience. If you can wait until January 1st of the following year, your first full calendar year of retirement, your earned income will have dropped to zero. That exact same $50,000 withdrawal will now fill up your standard deduction and the lowest tax brackets first, potentially saving you thousands of dollars in unnecessary taxes. Number 3, appealing the 2-year Medicare surcharge lookback. This is a point that infuriates almost everyone who discovers it because it feels entirely unfair. When you turn 65 and enroll in Medicare Part B and Part D, your monthly premiums are not a flat rate. They are dictated by a system called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. Here is the agonizing tension. The Social Security Administration determines your IRMAA surcharge by looking at your tax return from exactly 2 years prior. So if you are retiring and enrolling in Medicare in 2026, the government is looking at the income you earned in 2024. In 2024, you were working full-time. You were probably at the very peak of your earning potential. Your income was high, which means the government is going to slap you with a massive surcharge, forcing you to pay hundreds of dollars more every single month for the exact same Medicare coverage as your neighbor. The IRS and the Social Security Administration expect you to just accept this and pay the bill. But what they do not advertise is that you have the legal right to fight it. Retirement is officially classified as a, quote, life-changing event. The moment you receive that initial IRMAA determination letter in the mail, you must immediately file Form SSA 44. This form allows you to formally notify the government that you have stopped working, your income has drastically plummeted, and they need to recalculate your Medicare premiums based on your current retirement income, not the ghost of your working past. Number 4, escaping the 60-day indirect rollover nightmare. When you leave your employer, you will likely want to move your 401k into a self-directed individual retirement account, or IRA. This gives you more control, better investment options, and lower fees. But how you move this money dictates whether you keep your life savings or hand a massive portion of it over to the government. Let us say you call your former HR department and say, "I am retired. Please send me my 401k balance." They will happily comply and mail a check directly to your house. This is called an indirect rollover. But by federal law, if an employer hands the money directly to you, they are legally required to withhold 20% for taxes. If you had $100,000 in your 401k, you will open your mailbox to find a check for only $80,000. Now, the IRS gives you exactly 60 days to deposit the money into an IRA, but the IRS expects you to deposit the entire $100,000 to avoid taxation. Where does the missing $20,000 come from? It has to come out of your own checking account, out of your own pocket, within that 60-day window. If you cannot come up with the cash, that $20,000 shortfall is treated as a permanent taxable withdrawal, subject to ordinary income tax and potentially early withdrawal penalties. The IRS expects you to fall into this trap. To protect yourself, you must never, ever touch the money. You must insist on a direct rollover, also known as a trustee-to-trustee transfer. The money moves directly from your old 401k provider to your new IRA custodian. You never see a check, there is zero tax withholding, and you completely bypass the 60-day ticking time bomb. Number 5, navigating the Social Security combined income threshold. There is a dangerous myth that Social Security benefits are entirely tax-free. In 1983, the government implemented a stealth tax called the combined income formula. The IRS looks at your adjusted gross income, adds in any non-taxable interest you earn from things like municipal bonds, and then adds 50% of your Social Security benefits. If that total number goes over a certain threshold, the IRS begins taxing up to 85% of your Social Security benefits. What makes this so devastating is that these thresholds, which are $25,000 for a single filer and $32,000 for a married couple, were set decades ago and have never been adjusted for inflation. When the law was written, it was designed to only impact the wealthiest retirees. Today, because of inflation, middle-class retirees are being dragged over these thresholds simply by existing and withdrawing basic living expenses. The IRS expects you to blindly pull money from your tax-deferred accounts, artificially inflating your adjusted gross income and triggering the taxation of your Social Security. The strategy here requires precision. You must diversify your retirement savings across different tax buckets. By pulling income from a Roth IRA, which is completely tax-free and does not count toward your adjusted gross income, you can keep your combined income artificially low. This prevents the IRS from double dipping and taxing the Social Security benefits you spent decades paying into. Before we move on to the second half of this list, let me ask you a crucial question. How many of you are planning to rely solely on your 401k for your first few years of retirement? Keep that in mind because what we cover in point number 9 is going to flip everything you know about accessing that money upside down. And remember, point number 10 is the RMD aggregation trap. the single most expensive mistake you can make. We are getting there. Number 6. Filing Form 1040-ES for estimated quarterly taxes. When you were an employee, taxes were invisible. Every time you were paid, your company automatically sliced off the federal tax, state tax, Social Security, and Medicare, sending it directly to the government on your behalf. You never had to think about it. In retirement, that automatic safety net vanishes. Now your income is coming from dividends, interest, capital gains in your brokerage account, and perhaps rental income from real estate. None of these income streams have automatic tax withholding. The IRS is not going to politely wait until the following April for you to pay your tax bill. If you owe more than $1,000 in taxes when you file your return and you did not make payments throughout the year, you will be penalized. The IRS expects you to step up and act like a business owner by filing Form 1040-ES and making estimated quarterly tax payments. You have to send the government a check in April, June, September, and January. There is a protective shield you can use called the Safe Harbor Rule to guarantee you never face an underpayment penalty. You just need to ensure your quarterly payments add up to either 90% of the tax you will owe this current year or 100% of the tax you owed last year. If your income was over $150,000 last year, that safe harbor jumps to 110%. The moment you retire, you must set calendar reminders for your quarterly taxes, or the penalties will slowly bleed your wealth dry. Number 7, deploying the net unrealized appreciation strategy. If you spent years working for a publicly traded company, there is a very high probability that part of your 401k is invested directly in your company's stock. Most retirees simply bundle up all their mutual funds, bonds, and company stock and roll the entire 401k into a traditional IRA. This is a catastrophic unforced error. If you roll company stock into an IRA, you permanently lock its tax status. When you eventually sell that stock and withdraw the cash from the IRA in retirement, every single penny will be taxed as ordinary income. Depending on your tax bracket, you could be surrendering up to 37% of that money to the federal government. The IRS has a hidden provision in the tax code specifically designed to reward you, but they expect most people to be completely ignorant of it. It is called net unrealized appreciation, or NUA. Instead of rolling the company stock into an IRA, you distribute the actual shares of stock directly into a standard taxable brokerage account. Yes, you will have to pay ordinary income tax that year, but only on the original cost basis, the price you paid for the shares decades ago. All of the explosive growth, all of the appreciation that occurred over the last 30 years is immediately reclassified. When you sell those shares, the growth is taxed at long-term capital gains rates, which max out at just 20%, and for many retirees can be as low as 0% or 15%. By utilizing NUA before you execute your rollover, you are legally sheltering massive amounts of wealth from ordinary income tax. Number 8, complying with the 2026 Secure 2.0 catch-up mandate. We are now living under the full implementation of the Secure 2.0 Act, and as of 2026, the IRS has fundamentally changed the rules for people in their final years of working. For decades, if you were age 50 or older, the IRS allowed you to make catch-up contributions to your 401k. This was a brilliant way to turbocharge your tax deferrals right before retirement. You could dump thousands of extra dollars into your pre-tax 401k, lowering your taxable income in your peak earning years. But the government realized they were losing too much tax revenue. As of 2026, if your wages from your employer in the prior calendar year were strictly over $150,000, the IRS no longer permits you to make your catch-up contributions on a pre-tax basis. The IRS officially expects and mandates that every single dollar of your catch-up contribution must be directed into the Roth side of your 401k. This is a jarring reality for high-income earners who are just a few years away from retirement. Because these contributions are forced into a Roth, they are made with after-tax dollars. You are no longer getting a tax deduction for that catch-up money, which means your immediate take-home pay is going to drop, and your current year tax bill is going to be higher than you anticipated. You must review your final working year's cash flow, because the IRS has permanently removed one of your best tax shelters. Number 9, utilizing the rule of 55. Most people believe with absolute certainty that if they touch their 401k before the age of 59 and a half, they will be decimated by a 10% early withdrawal penalty from the IRS. This belief keeps thousands of people trapped in jobs they hate, delaying their retirement purely out of fear. The IRS expects you to follow the general rule, but they also offer a very specific, narrowly defined exception known as the Rule of 55. If you leave your job, whether you resign, are laid off, or retire, during or after the calendar year in which you turn 55, you can immediately begin pulling money from that specific 401k without paying a single dime of the 10% early withdrawal penalty. You still pay regular income tax, of course, but the penalty is waived. Here is the tension, and the reason so many people mess this up. The Rule of 55 only applies to the 401k associated with the job you just left. It does not apply to any IRAs, and it does not apply to old 401ks from previous employers. If you are 56 years old and you consolidate all of your old 401ks into an IRA before you understand this rule, you have just locked up all of your money until age 59 and a half. The protective move is to reverse engineer this. If you want to retire at 55, you must roll your old 401ks into your current employer's 401k before you quit. Once all the money is pooled in the current plan, you retire, trigger the Rule of 55, and gain penalty-free access to your entire life savings years ahead of schedule. Number 10, the RMD aggregation trap. We have finally arrived at the most dangerous, most heavily penalized, and most misunderstood rule in the entire United States tax code. This is the absolute best point I can give you, and ignoring it will cost you dearly. Under Secure 2.0, when you reach age 73, for those turning that age in 2026, the IRS forces you to start pulling money out of your tax-deferred accounts. These are called Required Minimum Distributions, or RMDs. The penalty for missing an RMD, or miscalculating it, used to be 50%. It has now been lowered to 25%, but a 25% penalty on money you spent a lifetime saving is still catastrophic. Here is exactly how the trap works. Let us say you are an incredibly diligent saver. Over your career, you have accumulated 2 traditional IRAs, a 401k from your last job, and a 403b from a brief stint working for a nonprofit. The IRS expects you to calculate a very specific RMD amount for every single one of those accounts based on their December 31st balance from the prior year. Most retirees try to be efficient. They calculate the total amount they are required to withdraw across all 4 accounts, and then they say, I am just going to pull the entire combined amount out of one of my traditional IRAs to make the paperwork easy. The IRS audits your return, sees what you did, and immediately slaps you with a 25% penalty on your 401k and your 403b. Why? Because the IRS has incredibly strict, utterly confusing aggregation rules. You are legally allowed to aggregate your traditional IRAs. You can calculate the RMD for 5 different IRAs and pull the total amount from just one. You are also allowed to aggregate 403b accounts with other 403b accounts, but you are absolutely under no circumstances allowed to aggregate a 401k with an IRA. Furthermore, you cannot aggregate one 401k with another 401k. Every single 401k plan you leave behind must satisfy its own independent RMD. If you calculate the total and pull it all from your IRA, the IRS considers the RMDs on your employer plans entirely missed, triggering the 25% penalty. The ultimate defense against this nightmare is to proactively consolidate all of your retirement accounts into a single IRA before you turn 73. One account, one balance, one calculation, 0 chance of an aggregation penalty. Retirement is not just about having enough money. It is about navigating the complex labyrinth of tax laws designed to separate you from that money. Today, we covered the critical importance of actively managing your tax withholdings through Forms W-4P and W-4R so you avoid massive underpayment penalties. We discussed the dangers of the first-year tax trap and how stacking retirement distributions on top of your working income can push you into the highest tax brackets. We exposed the 2-year lookback period for Medicare IRMAA surcharges and how you must use Form SSA 44 to protect your Social Security benefits from silent deductions. We also navigated the critical difference between indirect and direct rollovers, the life-saving net unrealized appreciation strategy for company stock, and the absolute necessity of understanding RMD aggregation rules before age 73. I know these rules can feel overwhelming, but you have worked entirely too hard to surrender your wealth to easily avoidable mistakes. I want to hear from you. Have you been caught off guard by any of these IRS rules, especially the Medicare IRMAA surcharge or the Rule of 55? Drop a comment below and share your experience. Your story might just be the warning someone else needs to hear today to protect their life savings. Stay vigilant, stay informed, and I will see you in the next one.